You've got this bomb, right? That's sizzling, right? Every year that you get older, Cory, this bomb is getting closer to exploding. And my opportunity for our audience is with smart planning, you can actually diffuse this tax time bomb before it explodes. Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me.
Cory, we've got a fun topic today. It's the retirement tax time bomb and what you don't know could cost you. Let me paint this picture for you, Cory.
Please.
Imagine you are retiring with $2 million saved up in your 401k. And then you realize that Uncle Sam owns, I don't know, $600,000 of that. How would that make you feel?
I would feel like I had a joint account with Uncle Sam that I didn't know was a joint account.
Yeah, I mean, here's the issue. Most retirees will actually pay more in taxes in retirement than they expect. A lot of people say, hey, I've worked for 20, 30, 40 years, Cory. I've been paying taxes on my W-2 employment all these years. Now my taxes, are going to be low. I'm retired. I don't have any more earned income, right? So, but the reality is that sometimes you're actually going to pay more, even in a higher bracket than you were working. And that's the bomb that we're talking about. Again, the challenge is you've saved diligently for many, many, many years, decades for most people, in tax deferred accounts like 401ks, IRAs. Maybe you even get a lump sum pension, Cory, that you're going to roll over to an IRA. But now here's Uncle Sam, Cory, Mr. IRS, gimme. They want their money. They want to collect. And they're certainly waiting for you. So here's the pain points. When you get into your early 70s, 73, 75, based on when you were born, you're going to have to do something called a required minimum distribution, right? Also, tax rates, even though they may not feel low to people, they're actually historically low. Who knows, in the next 10, 20, 30, 40 years, tax rates actually may be higher, just the brackets themselves. There's this horrible thing, Cory, that I'm going to let you talk about, IRMAA, with Medicare, that actually costs you more money for Medicare if you have more income. And then to top all that, Cory, part of the bomb is your Social Security can be taxed if you make too much money. And it's actually a very low number before your Social Security is taxed. So these are all painful, horrible things that you and I and our team of financial planners help our clients navigate. Do we need to unpack any of this before I talk about actually some good stuff and the opportunity?
I think it is. Yes, there's one thing I want to point out here, Jake, and that is the taxes in retirement that we're talking about here that can really kind of be this time bomb. I think that taxes, Jake, are the number one expense that people have to deal with in retirement, right? We don't always think about taxes as an expense, but that's number one for almost everyone. And I think that with the proper planning, you can help alleviate some of that. But without it, going into retirement a little blindfolded around what the tax situation is going to be is tough.
Yeah, because you're right. When people come into my office, Cory, they're usually concerned about healthcare, spending too much money. They're worried about the stock market.
Yep.
They need to be worried about taxes.
Yep.
And the good news is with taxes, Cory, with some proper planning, you can actually do yourself a big favor.
Right. Exactly.
So let's get into these pain points though just a little bit more. I want to just define them for our audience that doesn't understand kind of what I'm talking about. So required minimum distributions, Cory, they start at age 73 or 75 based on when you were born. It starts at around 4% of your account. So if you've got $2 million, like I talked about, the IRS is going to force you to pull out $80,000 roughly, this is approximate, from those pre-tax accounts once you reach your required minimum distribution age. And again, if you're getting Social Security or you have other income sources, this can push you in a pretty high bracket pretty quickly. So that's what RMDs are, required minimum distributions. I talked about tax rates and how they float. Cory, why don't you go into IRMAA a little bit?
Yeah, so IRMAA is basically the cost for Medicare. It's a surcharge that can increase the expense that someone has to pay. I think it's income related monthly adjusted amount. Something along those lines, Jake, is what the acronym stands for. But basically, there's those thresholds that if somebody's taxable income is above a certain threshold and it changes as the income grows, the cost for Medicare becomes more expensive. And I think for people that are planning for retirement. You could think if you have a pension, you have Social Security, your required distribution that you're obligated to take, that may very well be what puts you over that IRMAA threshold. And all of a sudden now you're dealing with more expensive healthcare through the government, through Medicare.
Right, exactly. And then we talked about Social Security taxation, again, which is a very low number. But if you pull out or have so much income, your Social Security can be taxed also. So you've got this fizzling bomb. Have you watched Saturday Night Live, Cory?
Yes.
You know MacGruber?
Yeah. Oh, yeah.
You don't want MacGruber being your financial advisor, by the way.
No,
don't hire that guy. But you've got this bomb, right? That's sizzling, right? Every year that you get older, Cory, this bomb is getting closer to exploding. And my opportunity for our audience is with smart planning, you can actually diffuse this tax time bomb before it explodes. And I've got
with 1 second left on the clock, like MacGruber.
Well, he doesn't diffuse it.
That's a good point.
MacGyver might, but MacGruber doesn't. So
that's right.
So there's some powerful planning that you can do. Number one are Roth conversions. Roth conversions are such a big deal for our clients. And I want to point out, first, I want to talk about what they are. And then I want to point out what an advisor should and what an advisor should not do. So a Roth conversion is simply pulling money out of your pre-tax 401k or IRA and moving that into a Roth IRA. Now, this is a taxable event, but what you're doing is you're diffusing this time bomb, because if you can do this soon enough before you have to take required minimum distributions, you can significantly lower that forced distribution and lower your lifetime taxes by doing Roth conversions. Now, the problem I see with other advisors, Cory, is that they are eyeballing it, or they're not even talking about this with their clients. A lot of advisors will say, if it has to do with taxes, go to your CPA. We can't even talk about it, which is a shame.
It's not very helpful.
No, it's not helpful. And so with us, again, we're not trying to be CPAs here at Falcon Wealth Advisors, but we don't shy away from tax planning. And so we actually will look at your full tax return, the entire 100-page document, however many pages it is. We'll use that as a starting point to then start running some Roth conversion projections. Now, here's the other issue. You got to do this every year. It's not a one-time, oh, you're going to convert 10,000 a year for the next decade, you'll be good to go, because the account value changes, Cory, tax rates change, your spending changes. So it needs to be an exercise that's completed with our financial planning group every single year. And frankly, you don't have to be retired to talk about this. I don't care if you're 40 years old. You should be at least talking about Roth conversions. I am 44, Cory, and I do Roth conversions.
What's the minimum age to do a Roth conversion, Jay?
Good question, Cory. There's not one. There's not a minimum wage.
Nicely done.
Trying to trick me, Cory. There's not a minimum wage. So again, You're just trying to juggle your tax bracket with these Roth conversions. Very powerful tool, but you got to do it. You got to talk about it every year. That's just a deal. It's just like getting your teeth cleaned. You might not like doing it, but I'll tell you, our team of dentists, just a joke, we're not dentists here, but our team of financial planners, they're happy to review your situation and see if a Roth conversion makes sense this year. Again, the next one, Cory, why don't you talk about strategic withdrawals? This is an exciting one, actually. I really like this one.
Yeah, I do too. So I think, Jake, this is being mindful of what expenses are on the horizon, what your taxable income looks like in a current tax year. Because I think the way that you just described, Jake, the Roth conversion, right? You can move money out of there and pay taxes on it on the front end. A strategic withdrawal could be effectively to accomplish the same thing, but it's just money that you're going to spend sooner. So I think if, let me just paint a quick example here, Jake. If it's 2025, I know that I'm going to have a $50,000 expense in 2026. Again, making up an example here. We could pick and choose what dollars it makes sense to take out of an IRA and pay taxes on this year versus how much of that we should take out next year and pay taxes on too. If it makes sense from a tax standpoint to be able to say, rather than just waiting until we're going to need this money, taking it all out and paying taxes on it, let's plan ahead and be strategic so then we can minimize how much those taxes really need to be.
Yeah, so pull from different types of accounts and be very strategic when you pull the money based on what your goals and objectives are. So that kind of leads into tax bracket management, right? Let's fill up those lower brackets with taxable money. And then if you have got other savings account or other money that's not taxed, let's use that when you have excess. That's tax bracket. That's an opportunity for managing your tax bracket. You can do that. We already know what the brackets are this year, so we can manage accordingly. And then the next opportunity, Cory, are charitable giving strategies. This is a huge deal, right? We joke about this, like the best way to lower your taxes is to not make any money or give it all away, right? And so if you are charitably inclined, there are vehicles like donor advised funds that we are very versed in, or just in your 70s doing something called a qualified charitable donation or distribution, where you're pulling money and giving it directly to a charity. My point is, if you are philanthropic, I don't care if it's $100, Cory, you should be talking about that with your financial planner so that they can help you make sure that you're getting the most bang from your buck as it pertains to this retirement time bomb. Because again, we can help diffuse it. If you're giving $10,000 a year to your church, but you're not itemizing because you're not in a high enough tax bracket, there may be other things you can do to still get tax benefits from this. So just bring it up to the financial planners and they're happy to go over this with you. All right, Cory, there's some great opportunity here. Roth conversions, strategic withdrawals, tax bracket management, and then charitable giving. I want to talk about our experience and a reference guide I've got for our clients. But first, a quick commercial. I want to thank all of our audience for tuning in. Our subscriber count continues to grow, our downloads, our views, all that stuff. If you think this show's any good, please give us a thumbs up, a 5-star rating. We think the algorithm allows more people to see it when you do that. Also, follow me out there on Instagram. It's Jake_Falcon_CRPC. Cory, yours is Cory Bittner, KC. Check us out on Instagram if you want more great content from me and Cory. Also, sneak peek here. We do have a listener suggestion that I'm going to go over at the end of today's episode. So be sure to tune into the rest of Upticks so you can hear that question or suggestion. All right, Cory. So I got a cool reference guide. It just came out actually, and I've got a copy. I got a copy right here, Cory. I know it might be backwards on YouTube here. So can you read backwards, Cory?
Yeah, looks like
you can
it
read
says,
backwards. Can you read upside down? All right.
Yeah,
Anyways,
I see our logo.
Our wealth journal came out for 2025. And in this action-packed booklet, Cory, we have the tax tables in here. So again, if you want to do some of your own kind of number crunching, please pick up a copy of this at our office at Falcon Wealth Advisors. It should be available soon at falconwealthadvisors.com. You can get a digital version. Check it out. It's in our wealth journal. We publish this sucker once a year. It's got a lot of information about our team, but it's got a lot of reference items for you so that you can make sure that you're doing the best that you can to help defuse that retirement time bomb, Cory. All right. So it's story time, Cory. Do you have any real world stories? Again, we're going to keep all the client stuff anonymous here, but do you have any real world stories you want to share with our audience today? I've got some, but do you have one?
Yeah, I've got several. I'll give you a real one. A client that we have worked with pretty diligently the last couple of years. We recognize, Jake, in their late 50s, early 60s. This is a client whose situation is probably going to require them to take much larger required distributions down the road than what it is that they're going to need, kind of going back to what you talked about earlier. So what we actually did is we mapped out on the front end, 15 years before the required minimum distributions begin, what the tax strategy looks like. We're evaluating the return each year, and then quite literally having a conversation each year. Should we convert X dollars to Roth accounts because it keeps us in the same tax bracket? They're providing some support to children, and I think even to grandchildren to some extent. Should we just take some distributions because there's going to actually be cash flow or expenditures that they're going to have on the horizon? But literally managing how much money is coming out of that account each year, how much is being reported as taxable income, and how that's feeding through to their tax return also gives us the flexibility, Jake, to make changes as things change in life, as the tax codes change. But we've backed into figuring out what this dollar amount needs to be, and then we're reevaluating it each and every year.
Yeah, that's a good one, Cory. Love it.
And it's really from the context of, and I think this might resonate for some people too. If somebody doesn't have the goal of leaving millions of dollars to their kids, when they're 90 years old, I don't think that trying to optimize for that number is the primary goal for most people. So I think, Jake, some people have thought about this too as a way of, how they can manage their legacy and their inheritance in a tax efficient way too, because the reality is it goes beyond just their own lifetime.
Yeah, I have some clients that want to pay the taxes for their kids, for example.
Right.
So because again, they said that my kids might be in a bigger tax bracket than me, so I might as well just pay them. Yeah, I love that. Good story on there. I got another story. We literally have had thousands of meetings about this stuff. Like we've got a lot. We could have
story time all day.
Infinite amount of shows probably with stories. So I've got one for you. It's a little bit different, but I really diffuse the bomb. I've done this for actually quite a few clients, but it's called net unrealized appreciation. So for our clients that have worked at publicly traded companies, if they've bought company stock in their 401k plan and they have a low average cost because that stock's done well over their career, Instead of rolling that money over, Cory, to an IRA when they retired, we took advantage of this advanced tax planning strategy called net unrealized appreciation. And we were not only able to avoid having so much money in a pre-tax account, we were able to sell or liquidate that stock at long-term capital gains rates, which oftentimes is lower than our client's ordinary tax bracket. So this again is advanced. Don't do any of this on your own. You need to meet with a wealth advisor that's licensed as a fiduciary, and then you also need to run this by your CPA so they understand how to file everything correctly. But my point is, I've been able to significantly lower future required minimum distributions for my clients, our clients, Cory, because of doing this advanced strategy called net unrealized appreciation. So again, it only applies typically if you work at a publicly traded company and you got to have that employer stock in your 401k, and you need to have a relatively low average price. So there's a lot of criteria that stack up that need to make this make sense for you. But my point is, I love it. I mean, we crunch the numbers, and again, we don't know exact because account values change and tax brackets change, but it can be literally hundreds of thousands of dollars depending on how sizable the account is. That's a story for me. Again, we could have an infinite amount of shows on stories where we do this, but like you said, Cory, the time bomb is something that you and I diffuse with our team all the time. I've got a 3-step strategy, a takeaway for our audience today, Cory, that they should think about. And this is very loose. So please don't take anything on our show as advice. This is all just kind of to get the conversation started and get your wheels spinning. But I've got three steps here. So pre-retirement. So this can be, Cory, late 40s, early 50s, 60s. This is when you should be looking at Roth conversions, believe it or not, even if you're in a high bracket. And you should be looking at something called tax efficient investing. Cory, why don't you talk about this?
We're going to talk about tax efficient investing. Yes. Yeah. So what investments you own in what type of accounts and how you're saving the money. So if you're saving money in a pre-tax 401k, for example, that's available to you through work, you're putting those contributions in, you're doing so before taxes. Eventually you'll pay the taxes on the distributions when you're retired. It's become more commonplace, Jake, that more 401k plans offer a Roth option as well, where people are paying the taxes on the money on the front end, basically when it's going in the Roth 401k, then it's invested and it's growing tax-free. And then really beyond that, a brokerage account, a taxable investment account outside of your 401k, outside of a retirement accounts, that can be another really powerful tool that people can utilize, one, for future tax planning, but two, to be able to actually control how you are investing tax efficiently and owning the right types of investments in each account.
Yeah, and I would argue, Cory, our clients today that are have the most flexibility and freedom in retirement have a lot of money in a brokerage account that they say, or a Roth. I don't have as many clients that have as much in Roth IRAs because Roth IRAs are newer accounts. So again, I'm a huge fan of, let's say you're, again, your early 50s. And what if you already have 4 million all in a pre-tax 401k? Well, oftentimes, Cory, again, this all dependent on your financial plan. I'll tell clients, let's keep putting money in to get the match, but you need to start building up a brokerage so we can have some flexibility in retirement, or Roth. Like Roths are better, arguably, but I really like the brokerage because you don't have to worry about age 59 and a half and blah, blah, blah. So brokerage is, again, super flexible account. That's what we mean by tax efficient investing. The other item you alluded to was asset location, which again can be strategic and good. But I think tax efficient investing is very smart when you're pre-retiring in your late 40s, 50s, 60s. So the next step, Cory, would be early retirement. This is what we talked about, strategic withdrawals. So what account are you pulling from? How much are you pulling? What asset class are you pulling from? And are you filling up the brackets? This is in your 60s and early 70s. This also will come down to, when do you turn on Social Security? It's a very important question.
Huge question
for the retirement tax bomb, right? So we may have you delay Social Security a few years because we want to do some Roth conversions or something else to help defuse that bomb. So again, meet with us before you turn on Social Security so that we can crunch the numbers and give you some strategy. But this is that second step. So it's, again, filling up your tax brackets, strategically pulling from the proper accounts, and then determining when exactly to turn on Social Security. Did I miss anything in this second step?
No, that's really good. I think that's exactly right.
All right, Cory, then the last one will be post, 70s, basically. So this is when your required minimum distribution age or older, so typically age 73 or older. Why don't you elaborate a little bit on QCDs, Cory, and estate planning with those?
Yeah, so qualified charitable donations, or QCDs for short, Jake, that you just mentioned. This is something that people, if they have money in an IRA at age 70 and a half, they're first eligible for. The beauty of this strategy,
Which is confusing, right? Because it's not 73. So you can actually do it at 70 and a half.
I know.
Is it qualified charitable distribution or donation?
I've heard both. I think it's
have you?
donation. Either way, though. Either way,
Whatever.
I think it's donation. But the qualified charitable donation / distribution, we'll call it that. It is used, though, back to the church example that you gave earlier, Jake. If someone knows that they're going to give $10,000 to their church in a year, they can gift that directly from their IRA. They could do that as a one-time gift at the beginning of the calendar year if they chose to do so. And that's $10,000 less that they have to take out of their IRA and pay taxes on themselves. And that $10,000 counts towards the total dollar amount that the government requires them to take out.
That's great. And so again, this all helps lower that amount. And you're giving them, this is our point about earlier, if you're already charitably inclined and you're giving to charity anyways, then QCDs are a very, very smart thing to do for the right people, as long as, again, lines up with your plan, just for compliance sake. So good. That's all part of it. And then estate planning, maybe you start gifting some money to your loved ones if you're going to have an estate tax issue. A lot of people don't fall into that because it is, I think it's around 14 million per person that you can give. So you can give 28 million away and you don't have to worry about federal taxes today, but that also could change. And maybe your kids want the money now because they're buying a first home or they're having young children, and they say, Mom and Dad, I don't want $4 million when I'm 65. I need 100,000 now. And maybe you start doing some of that, and that's part of estate planning. Again, that's all part of this framework that I'm setting. So you've got pre-retirement, early retirement, and then post-RMD age or required minimum distribution. These are all different steps that our financial planners are well equipped to talk our clients through and crunch the numbers, but they require a different framework and a different mindset when you're in each one of these phases of your life. So again, that's why it pays to have a trusted fiduciary by your side during this. All right, Cory, I got a myth here. Here's a big myth. All right, ready?
All right, let's hear it.
A lot of people think this. I'll be in a lower tax bracket when I retire. And the truth is, Cory, many clients may be in a higher one, especially when these RMDs take into account. Have you seen clients go into higher tax brackets in your 15-year career?
Yes, I have.
Could elaborate on that a little bit.
I've seen it happen. I've seen it where clients they have ended up in a situation. I've also seen it, Jake, where their kids have ended up in a situation, which I want to come back to here in a moment, where they are, by the time they're retired, if they're collecting Social Security, if they're collecting, a husband and a wife or partners, if one or both of them has a pension, before they touch their IRAs, Jake, they end up in a situation where their taxes may be very similar to what it was while they were working. Now they've got to take required distributions. That actually bumps them into a higher bracket than they were in when they deferred the income in the first place, which is basically the inverse of what we want to happen, right? We want you want money to go into the 401k when you're in a higher tax bracket. So when you're taking distributions in retirement, it's going to be lower, but you've got to recognize that. I think that's the myth, Jake, to your point, but there's a lot that goes into that. There's a lot that goes into ensuring that you're in a lower tax bracket in retirement than you are.
Yes, Cory. And the perfect shift for this is like we were taught at young ages, early in our careers, just sock money in that 401k, put it away, Cory, set it and forget it that you learned about Ron Popeil.
That's right, Ron Cal.
So passive tax deferral, that's kind of the way when you're starting out, you have to shift to proactive tax strategy.
I love it. That's great.
Yeah. Thank you. I said it. This shift has to happen in that pre-retirement phase. That's when you start shifting over to being more proactive about your tax planning, and let's diffuse that bomb together. But this is very difficult to do on your own. And again, this is our big value add for our clients, is that we've had thousands of meetings going over these exact strategies, and we can take a look at your situation and see what makes sense for you and your family and your financial plan. So go ahead. You had an estate thing you wanted, or did you already?
Yeah, just the one other point I wanted to make too, though, is that you don't want to pass the time bomb along to your children either, right? So to your point,
hot potato game. You don't want to do that.
Yeah, and there's a few different ways to look at that, right? If somebody's going to inherit $1 million and they've got to pay a bunch of taxes on that, you could argue they're still inheriting $1 million, right? And a lot of it's going to go to Uncle Sam. My point is that if your children are in a higher tax bracket, that could very well be, Jake, the way that people end up. There's more taxes paid on the money that they saved while they were working before they retired, regardless of whether they pay that taxes in their lifetime or their kids do, which is why that
Right.
proactive tax planning can be so impactful. But you don't want to just pass along that time bomb to your kids, because the whole point here is we're trying to minimize what the cost is, what the dollars are that goes to Uncle Sam over the life of the money, even beyond your own lifetime.
Yeah, that's good. Yeah, that's what one of our lead planners, Jake Cross, says a lot of times. Cory, he'll say the goal is to pay the least amount of taxes possible, right? And over the life, not year to year. That's a big misconception. Is people just try to pay the least amount of taxes in any given year. We want to pay the lowest lifetime tax bill. And actually, our financial planning software, Cory, can project out and tell you exactly what your projected lifetime tax bill is. And I don't like showing it to people because
it's a big number.
Usually makes them mad or freaks them out a little bit. But what's cool about it is I can say, all right, Cory, your lifetime tax bill is going to be $4 million. But if we do X, Y, Z, A, B, C, 1, 2, 3, we can cut that 4 million to 3 million, which means that's $1 million more dollars to your kids, right?
Yep.
So that's the power in shifting this mindset to a proactive tax strategy. So quick recap, Cory, the retirement tax bomb, it's real. But the good news, Cory, it's avoidable, right? You can do planning. So you need to plan for these required minimum distributions, look at Roth conversions, and take tax smart withdrawals. And the earlier you start this, the more control you have. The worst case would be to be, 73 years old and have $8 million all in a pre-tax account and haven't done any planning. I mean, then our options are a lot tighter. And so it's more difficult. So again, the earlier you do this in your 40s, 50s, 60s, that's when we want to start doing this. So that's good, Cory. So a quick call to action. Again, if you are struggling with this, or if we just opened up your mindset to something you haven't thought of and you're in your 40s, 50s, 60s, or I don't care, even if you're retired, just send Luke a message. Luke is our content manager. He's our communications manager. Simply email luke@falconwealthadvisors.com. Let him know you've got more questions. Luke will share my schedule or Cory's schedule. Doesn't matter to us. And we're happy to have a conversation with you to go over this time bomb and see what we can do to help you diffuse the lifetime tax bill that's coming your way. It's coming all of our ways.
That's right.
All right, good. Be sure to like and subscribe as well. Cory, I do have something from a listener. So thank you to the listener.
Yes.
I sent this in. Let me pull it up here, Cory.
Okay.
All right, here's a question. You ready?
Yep.
All right, as we wrap up today's show, here's a question for Jake and Cory. I've got to use a different word because our compliance doesn't like these buzzwords. But basically, he's asking, when is the most opportune time for Roth conversions? What's our philosophy on this? And I've got a thought on this, Cory, and we can differ on this a little bit because the reality is there's no perfect time. I mean, the perfect time is when the market's down, you convert it, then the market shoots back up. Right?
That was my answer, Jake.
But nobody can do that. So I like doing it two times. And this comes from Jake. One of them comes from Jake Cross. So Jake likes to, I've seen him tell clients this, he likes to do it in two different phases. So if we know, let's say, for example, Cory, we determine we need to do 40,000 and it's going to work out for you. He'll like to do 20,000 at the beginning of the year and then 20,000 in the fourth quarter, because he wants to double check of any other taxable events may have happened to you throughout the year, just to make sure we're managing that bracket. And it also diversifies the timing of it a little bit, because if the market's up or down when you do it, it'll also diversify that. So I like when he does that. He phases it in over the year. But if you get a big market crash and you're going to do it, if the market pulls back 10, 20, 30%, that's not a bad time to do it. I like to pound the table a little bit on Roth conversions then, Cory. Again, there's no guarantee that the market won't get worse before you do it, or the stocks that we put in your Roth won't get worse. But if you want to be very strategic and tactical, you get a big market pullback. I also like Jake's two-step phased-in approach. What about you, Cory? Do you have thoughts on this?
No, what you just described is fairly aligned, Jake, with what I would say. The point I would make, though, is I think the ideal optimal time to do the Roth conversions is when you're going to presumably get the largest ROI on the choice that you're making in the first place, which really kind of boils down to your tax situation in that calendar year. But I think the market piece can be a big part of it, Jake. I know clients that I worked with back in 2020 during COVID, when the market crashed, some Roth conversions that we did back then, where it felt scary for people to pay taxes on the money that they were converting that was already down in value from where it was just a month or two ago. But those taxes that they paid and the market recovery since then, they've made a lot more money, right? Because they already paid the taxes on the front end, and all that growth now is tax-free. So it's like so many other things, Jake. I think when we can talk about buying low or selling high. It's easy to explain. It's difficult to do. The same thing with the Roth conversions. I think that when the markets really get wonky, when there's a lot of volatility, those opportunities can be optimal for what we're talking
about. Yeah. So again, it comes down to your plan. What makes sense? So you can't time it perfectly, but you're right. You get a big crash, and you want to do it anyways. Let's do it. Either way, we should be having that conversation with you every single year. So our planners will bring it up. You bring it up. Call us, email us, question us, whatever. And thank you so much for that listener that sent in that question. Please keep them coming. Just send them simply to Luke@FalconWealthAdvisors.com, and Luke will make sure that Cory and I address your question live here on Upticks. All right, Cory, I've got like 60 seconds. What do you got? Anything personal you want to share with the potential millions of people tuning into Upticks?
Jake just wrapped up a week with my birthday, my daughter's birthday, her first birthday party, and Father's Day. So it has been a lot of fun. It was the gauntlet. Happy to be on the other side of it, and looking ahead for the rest of the year.
Cory, did you drink any alcohol during these celebrations?
I drank some, yes.
Did you go with beer or liquor?
Beer.
So you could kind of just maintain it.
Yeah, beer. It's like, we need beer. It's a first birthday party. So
you had beer. Sorry, I missed it.
That's all right.
I know I'm a bad friend, but
no,
I felt bad. Rachel's going to take Cassie out for wine, I think, or something.
That's right. How about you? What's new with you?
Not much. Just coming back in here to golf season. I'm excited. We've got 2 new team members at Falcon Wealth Advisors, yes. Cory. So Calvin Dillon and Michael Fegan just joined us. So we're real excited to get them trained up. They're going to be joining our operations group initially as they learn more about our team. So we're real excited to have them. So just working away here, Cory, at Falcon, while you're having all these parties, drinking all this beer.
That's right.
I'm working.
Yeah, keep it up, Jake. Keep up the hard work.
So that's about it. Patio's almost done. So I'm hopeful that that's done in the next month or so. But just trying to keep my wife happy. Happy wife, happy life, Cory. That's what I'm focused on.
That's good. That is good. So, that will serve you well.
That's right. Well, thank you as always for joining me, Cory, and thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, FalconWealthAdvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.